Welcome to Business Talk, and time to talk about the state of South Africa's capital markets, which, let's face it, are actually in a state of existential crisis. And I don't say that flippantly. Yes, there's obviously a global trend towards fewer listed companies with the rise of private markets, but in South Africa, the delisting deluge is acute. Looking at the Johannesburg Stock Exchange, it faces a daunting challenge. Over the past 2 decades, the number of listings has nearly halved, dropping from 616 in 2000 to just under 300 in 2023. And it's a confluence of factors, global and local. A big one is economic growth. Another big issue is the listings process. And I know the JSE is acutely aware of this as well. But how do the JSE delistings impact your investment portfolio? And I think that's a big question for investors at this time, as we see Reg 28 lifting the limits that we can take offshore. Increasingly, I'm fielding questions from viewers about what they should be doing. Wendy Myers, Head of Securities at PSG Wealth, welcome. I'm sure you're fielding questions from your clients as well. And, you know, the JSE is shrinking. I think the number of companies reaching 284 at the end of last year, according to the Korean Capital Report. How should local investors think about investing in the JSE?
Yeah, thanks, Michael. Look, I agree with you. I think it is very sobering, what we're seeing on the JSE. And I think what investors need to be aware of is that because of this reduction in the number of single stock counters, you'll be aware that obviously there's been quite a rise in the number of ETFs that are being listed. But the key implication for investors they need to be aware is market concentration. It's a key risk for investors if they are buying some of these market ETFs, because effectively the JSE is dominated by China-related internet. So think of stocks like Naspers and Prosus, and even commodity stocks. And you'll know, Michael, the commodity landscape has really taken a bit of a beating. So investors should not assume that because their portfolio has exposure to these market ETFs, that actually you're diversified. That's not necessarily the case. And I think as an investor, you need to be aware of this before you start investing.
Yeah, it's a very important point that you raised earlier about the fact that we do see ETFs increasing in number and variety, and actively managed ETFs and that kind of thing. But what are the implications for stock portfolios, and what steps can investors take to then protect themselves, given what you've just said about diversification?
Well, I think to start with, we must acknowledge that at the moment, the share prices on the JSE are low. And they're actually quite cheap, really, when you compare it to overseas markets. And I think a really savvy investor can benefit from this, especially if they invest in those stocks that have high dividend yields, because really what that does is it delivers almost bond-like returns, because how much lower can the share price go? But you still have that optionality from an equity exposure perspective to give you that benefit of upside, which is a nice place to be in my opinion. And then I think key component that we always talk about is certainly focusing on stock selection. And that really means you need to invest in stocks that have these high dividend yields, and also that drive low share price volatility. And that'll give you those sort of bond-like yields that I've spoken to. Be very careful about investing in companies that have what we call value traps. And that is where a company isn't in control of their revenue. Maybe they are their revenue is very correlated to rand dollar and have limited control over their costs. Maybe they might be highly unionized, as an example, or their input costs are beyond their control. And always focus on long-term investing. Don't consider the state of the JSE as it is now, that it's going to be like this forever. I mean, interest rates are high. We've spoken to that previously. So that as interest rates come down, so the share prices will have a positive impact. But be sure to invest in those dividend yielding stocks, so that over time you have the benefit of compounding, not just from the yield of the dividend, but also on the market return, which is the equity upside that I've spoken to.
Yeah, and given where valuations are at the moment, one could only assume that equity upside is pronounced. That potential for equity upside is pronounced. And as we're speaking, I think National Treasury has just announced the response to the FATF grey listing from the Mutual Evaluation Report. And we've actually done exceptionally well, where most countries, comply within 3 years. We've complied with all but 5 within 2 years. We've had the very welcome announcement of a market and business-friendly CEO at Transnet, and a rabbit pulled out of the hat in the budget. So, things can actually turn despite all the doom and gloom out there. What are the considerations our investors to take into account when we're talking about this ever-shrinking JSE?
So I think a key that comes to mind is always diversification. So don't just look at the JSE as your sole solution for investing. I think it's important for investors to consider the impact of the valuation of the rand when they consider their portfolio returns. So what I like to say to investors is start having a dollar-denominated or even Swiss franc denominated currency and look at the returns in that currency. And then you'll get a feel for how your portfolio is performing over time globally. Because you need to remember, certainly in your retirement years, certain costs might increase above inflation because they're more exposed to the ZAR dollar exchange rates. I think a key point is medical care. We are aware that can have above inflationary increases. And as you are in retirement, you're more exposed to that. So your portfolio needs to be a lot more robust to withstand some of these greater than inflationary impacts. And I think I really would recommend investors looking at investing a portion of their portfolio in offshore listed securities. We recommend at PSG as much as almost 40% of your total portfolio. And that will give you exposure to a plethora of other stocks available. I think it can be quite daunting. So what's also possible is to invest on the local exchange through denominated ETFs that have exposure to offshore stocks, or through feeder funds, and they are rand dominated, but they reference offshore stocks. Also remember that when you invest in Rate 28 portfolios, like you mentioned, Michael, you will have exposure to offshore portfolios there. So you probably find that you already have some exposure. And then I think also consider enhancing your portfolio diversification by looking at which listed ETFs, and I've mentioned earlier that there has been quite an increase in the number available on the JSE that complement your current portfolio. And that will make you achieve those diversification benefits that I think is so important to investors. And then consider also effective investment vehicles. I mean, it's February now, and I think there's a lot of information in the media around tax-free savings accounts and how that can benefit you and your family. So look not just at diversification of your portfolio, but look at diversification of investment vehicle.
Yeah, and with that comes, I think, a little bit more complexity than just plain old vanilla, let's park it in a Satrix top 40 on the JSE. So it seems fairly clear that a financial advisor would be able to assist in our decision-making through this process.
Very much so. I can't stress that enough, actually. I think what you need to look for in a financial advisor is a true professional that's an active manager that has strong fundamental skills, because they are able to guide you into which stocks to invest in, and also when to consider ETFs. Because sometimes we are worried about the liquidity of certain ETFs. So I really think it's important to spend time with an advisor to guide you. And their role is multifaceted. It's really to provide holistic advice in the context of your long-term goals. And they can guide you, stressing the importance of equity diversification to the point we made about local and offshore investing. They can guide you on the right vehicle, especially when considering the stage you are in your investment life. And the types of stocks and ETFs to buy, I think that's a key requirement for a financial advisor, because they can guide you around that concentration risk, which sometimes it's difficult for an investor on their own to decide on. And then really, what is the best way to incorporate offshore diversification into your balanced portfolio? Because, we all know the options of stocks available offshore and I think it's important to have an advisor guide you as to your next steps. And remember, Michael, there's different ways of getting money offshore. So it's important for your advisor to guide you in the process. And then I think finally, and we spoke to this, I think last year, the importance of spending time with your advisor, reviewing your portfolio on a regular basis, not just to make sure that you keep to your goals, but also to make sure that your concentration risk that we've talked about is minimized.
Yeah, and given that it's around February that we're chatting, tax and tax planning and considerations around capital gains tax or tax-free savings accounts, or how much into an RA. We're moving into a two-pot environment now. What does that mean? If previously you thought, well, my RA is locking all my money away, all of these things to consider again, which is why it makes such sense just to sit down with a professional. And I've met some fantastic financial advisors out there. Sadly, there have been also a few sharks. And I think, the industry shouldn't be tarred with the brush of a few sharks. There are some really professional, I would liken them almost to financial coaches out there who walk a journey with you throughout your life and become good friends, actually. Many invited to client weddings and, are there for milestones like the birth of your first child and that kind of thing, and then seeing them walk down the aisle. It becomes that kind of relationship. And it's because our finances, like our health, should only be really handled by professionals. We wouldn't trust a fly-by-night doctor. So I certainly don't trust a fly-by-night financial advisor.
Absolutely,
Wendy Myers,
Michael.
thank you so much. Head of Securities at PSG Wealth. Some really good advice on how investors should navigate the sinking JSE here on Business Talk.
Thank you, Michael.